Every time you tap a credit card, money moves. But not all of it goes where you think. Imagine spending $100 at a restaurant. To you, the transaction feels almost invisible. You tap, the payment goes through, and you walk away. But behind that single moment is an entire financial machine involving the merchant, the bank that issued your card, the payment network processing it, and multiple companies taking a small piece of the transaction. Now comes the strange part. Your bank may actually want you to spend more. It gives you cash back, travel points, discounts, airport lounges, sometimes even a sign-up bonus worth hundreds of dollars. Why would a financial company pay you to spend its money? Because the card itself isn't the real product. The real business is everything happening behind it. Every purchase can generate interchange fees. Every unpaid balance can generate interest. Annual fees add another revenue stream. And millions of transactions turn tiny percentages into billions of dollars. So where does that money actually go? And how can banks afford to give customers rewards while still making enormous profits? To understand that, we need to follow one ordinary credit card transaction from the moment you tap to where the money ultimately ends up. You walk into a store, choose a $100 product, pull out your credit card, and tap. From your perspective, the transaction is finished in seconds. But financially, that $100 purchase has just triggered a chain reaction involving several different businesses. The merchant wants its money, but the merchant usually doesn't receive the entire $100. First, the transaction passes through the merchant's bank, known as the acquiring bank or acquirer. The payment is then routed through a card network such as Visa or MasterCard, which connects the merchant side to the bank that issued your credit card. That issuing bank approved the purchase and ultimately provides the credit you used, and all of these participants can get paid. Part of the merchant's processing cost comes from the interchange fee, which generally goes to the card's issuing bank. Then there are network assessment fees paid to the card network, along with processor and acquirer fees for handling the transaction. So imagine that the merchant sells you something for $100. The customer sees $100, but behind the scenes, the merchant may receive slightly less after processing costs are deducted. That sounds insignificant. A few dollars, or even less, on a $100 transaction doesn't seem like a business capable of producing billions. But scale changes everything. If millions of customers make millions of purchases every day, a tiny percentage attached to each transaction becomes an enormous stream of revenue. The power isn't in taking a huge amount from one customer. It's in taking a small amount from almost everyone. And that leads to the most important fee in the entire system, the one that quietly turns everyday spending into a major source of bank revenue. Interchange is one of the most important pieces of the credit card business, and yet most customers never see it. In simple terms, interchange is a fee associated with a card transaction that is generally paid by the merchant side and transferred to the card issuing bank. It helps compensate the issuer for providing the card, extending credit, managing fraud risk, and maintaining the payment relationship. The amount isn't always the same. It can vary depending on the type of card being used, how the transaction is processed, the merchant category, the level of risk, and whether the purchase happens online or in person. Premium rewards cards can carry different economics from basic cards, because the financial system has to account for the rewards and benefits attached to them. Imagine that same $100 purchase. The merchant doesn't simply hand over a percentage to one company. The transaction generates several layers of costs, with the issuing bank receiving interchange while the network processor and acquirer collect their own portions. For the customer, the difference may be invisible. For a bank processing millions of purchases, it becomes the opposite. Suppose a bank earns only a small amount on an average transaction. On one purchase, that revenue might barely matter. Multiply it across thousands of transactions, then millions, then billions, and the economics completely change. This is the fundamental principle of financial scale. You don't necessarily need to make a fortune from each customer when you can participate in an enormous number of transactions. And credit cards are exceptionally good at creating that volume. Every grocery run, airline ticket, restaurant bill, subscription, and online purchase can become another tiny revenue event. But interchange creates only one stream of money. The truly powerful part of the business begins when the customer doesn't pay the bank back in full. The interchange fee may earn a bank a small amount from a purchase, but interest can keep generating revenue long after the transaction itself is forgotten. The difference comes down to one decision. Does the customer pay the statement balance in full, or carry part of it into the next billing cycle? If the balance is paid in full, the card may function primarily as a payment tool. But when a customer carries a balance, the remaining amount becomes revolving credit, and the issuer can charge interest based on the card's annual percentage rate, or APR. Consider someone who spends $2,000 and doesn't pay the entire statement. Perhaps they make a partial payment and leave a balance outstanding. That remaining debt doesn't disappear. It can continue accumulating interest month after month until the customer pays it down, and minimum payments can make that process last considerably longer. This is where the economics become dramatically different. A transaction that might have generated only a small interchange payment can create a recurring stream of interest revenue from the same account. But banks don't build their business around one customer. They manage enormous portfolios containing thousands, hundreds of thousands, or even millions of cardholders. Some customers pay everything on time and generate relatively modest interest revenue. Others carry balances for months or years. Some eventually default. The bank's economics depend on what happens across the entire portfolio. And the interest collected isn't pure profit. Issuers have funding costs. They absorb credit losses when customers don't repay. They spend money on technology, fraud prevention, customer service, compliance, marketing, and rewards programs. Still, revolving balances can become one of the most valuable parts of the business. This reveals what a credit card really is. It isn't simply a piece of plastic that makes purchases easier. It's an instant line of credit attached to a payment network, and the bank's economics change dramatically when convenience turns into borrowing. But then comes a strange question. If banks can earn money from customers carrying balances, why spend billions offering cashback, travel points, and rewards that appear to give money back? The answer takes us to the other side of the transaction. Cashback feels like free money. Airline miles feel like free flights. Hotel points can feel like a gift simply for using a piece of plastic you already carry. But from the bank's perspective, none of these rewards are free. Rewards are an expense, and issuers have to fund them somehow. One important source is interchange revenue generated when customers use their cards. Interest from customers who carry balances can contribute to the overall economics as well. And then there is another powerful source: annual fees. Premium cards can charge substantial yearly fees in exchange for travel credits, lounge access, insurance, points, or other benefits. The customer sees the benefits. The issuer sees a carefully calculated financial equation. Because rewards aren't just designed to give money away. They're designed to change behavior. Customer who earns points for every purchase has an incentive to use that card more often. Instead of reaching for cash or another card, they may put groceries, restaurants, subscriptions, travel, and everyday expenses onto the same account. That increases spending volume, which can increase transaction revenue. And the bank isn't necessarily trying to make every customer equally profitable. Some customers are transactors. They pay their statement balance every month, earn rewards, and generate relatively little interest revenue. Others are revolvers, carrying balances and potentially producing much more interest income. Some customers spend enormous amounts, creating substantial transaction volume even if they never pay interest. Others barely use the card at all. The bank can tolerate these differences because it evaluates the portfolio as a whole. A rewards program can therefore make economic sense, even when an individual customer appears to be winning. The real objective is often greater usage, stronger customer loyalty, and a larger share of the customer's spending. But there is still a missing piece. If the bank is paying rewards to encourage you to spend more, someone has to absorb the costs somewhere else in the system. And that brings us back to the place where the purchase actually happens, the merchant's checkout counter. From the merchant's perspective, credit cards are not free. Every transaction can come with processing costs, including fees associated with the acquiring bank, processor, network, and interchange. For a business operating on thin margins, even a small percentage can matter. So why accept cards at all? Because refusing them can create an even bigger problem. Cards make checkout faster and easier. Customers don't need to carry cash, count bills, or worry about having enough money in their wallet. That convenience reduces friction at the exact moment a purchase decision is being made. And there is another possibility. Customers may spend differently when payment feels effortless. A purchase that might feel expensive when paying cash can feel less immediate when a card is simply tapped or inserted. For merchants, that can make card acceptance part of the cost of doing business. Imagine a restaurant that suddenly stops accepting major credit cards. The restaurant may save processing fees, but customers accustomed to paying by card could simply choose another restaurant. The same logic applies across retail, travel, online shopping, entertainment, and countless other industries. Competition forces participation. In some cases, businesses can try to recover part of their payment costs through pricing, payment, method incentives, or minimum purchase policies where legally permitted. Larger merchants may also have enough transaction volume to negotiate more favorable processing arrangements than smaller businesses. But the fundamental trade-off remains. The merchant pays for access to a payment system that customers value. The customer gets convenience, credit, rewards, and sometimes greater purchasing power. And the financial institutions get access to a huge stream of transactions. That is why the system survives. Everyone is giving something up because everyone receives something they consider valuable in return. But there is still a critical player we haven't fully examined. When you tap your card, the merchant doesn't directly communicate with your bank. Something sits between them, quietly routing enormous numbers of transactions across the economy.